Welcome to another episode of Taking Stock for the week ending the 10th of April 2026. I'm Trinh, Head of Research at Stock Doctor, and joining me today is our senior analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. Hope everyone had a great Easter, and how was your Easter?
Plenty of chocolate eggs, Kien.
Yeah, I know, with all the kids having so much energy these days with all those that sugar. But before we begin, just a reminder that the information we discuss today is of a generic nature and doesn't take into account your personal circumstances. Now, Jace, markets have rebounded strongly this week after a volatile period, and the key catalyst has been the two-week ceasefire in the Middle East and the reopening of potentially the Strait of Hormuz, which carries roughly 20% of the global oil supply. Now, that's led to a sharp fall in oil prices and a recovery in equity markets.
Yeah, indeed, it's been a pretty interesting week of events, Kien. But more importantly, markets are reacting to a potential shift in probabilities. I mean, a worst case scenario could imply energy supply is severely disrupted, and this has been taken off the table this week on the back of the ceasefire. But what we have seen as a result of this is a very strong rebound in equity markets, particularly in the banks and also resource sectors, which were heavily sold off prior to this.
Yeah, that's right. But underneath the surface, I think investors are still quite cautious. What we're seeing is more of a rebalancing of portfolios rather than a full shift back into equities. Even though the market is trading around 3% from its highs, within our star stock universe, though, there are still many high quality stocks that remain oversold and represent opportunities for the long term.
Yeah, and they include many names within the tech healthcare space, including Pro Medicus, Aristocrat Leisure, Net Wealth, and also REA Group as well, and ResMed, not to single that out as well. And these companies continue to display pretty solid fundamentals and pretty reliant earnings revision into FY26.
Yeah, definitely with Pro Medicus also announcing that contract early in the week. But at the portfolio level, investors should be focusing on those businesses with strong financial health, those resilient earnings, and also the ability to navigate economic cycles. Because even if this conflict does end, there are still aftershocks. You've got inflation and economic growth, which could slow, and that could mean weaker businesses will struggle. And it's the higher quality companies that will eventually emerge stronger. But turning our attention to some star stock highlights of the week, let's start with Bendigo and Adelaide Bank. A star income stock, that share price rallied quite strongly after their quarterly update. What stood out here?
Well, Keen, the company delivered a pretty strong growth in cash earnings, which was up by around 8%. And this was supported by improved lending growth and also lower costs. Net interest margins, interestingly, also increased by around 2%. And this reflects better deposit pricing and also higher rates in this current environment. Furthermore, there were some strategic cost out programs that the company has implemented, and this has supported earnings.
Yeah, definitely. They did have partnerships with Infosys and Genpact to improve their productivity, and that's through technology and AI. And that's expected to deliver roughly around 65 to 75 million in annual cost savings by 2028. And that's quite meaningful given the bank of this size.
Yeah, it's good to see the bank invest in AI. But what it also means is that it can support the dividend and the yield remains pretty attractive at around 8%. So it appears sustainable for now, and also supported by a payout ratio, which is unstretched at around 75%. What's also positive, Ken, is that earnings revisions over the last 3 months have been positive. So that's also pretty much supporting a lot of the sentiment around the stock.
Yeah, banks continue to do quite well in this environment. But moving from banks to resources, copper producer Sandfire Resources, star growth stock. Now, the latest update was softer than expected. What happened here?
Yeah, it was a pretty unfortunate series of events. Production fell by around 6% quarter on quarter, and this was due to operational issues at Matsa in Spain, and also heavy rainfall and maintenance reduced some of the output. While at the Mathio asset in Botswana, there were some delays in terms of assessing or accessing higher grade ore, and this impacted production. Positively, management is still targeting full year guidance, but it is towards the lower half of what they put out to market.
Yeah, interesting, isn't it, Jace? But does that change the investment thesis?
Well, this is the interesting question that I think a lot of investors were asking this week. I think on the whole, not materially. I mean, these issues appear to be operational rather than structural. Costs remain relatively in line, and capital expenditure has been reduced, and the company remains in a pretty positive net cash position. So these bode well for its fundamentals.
It's still very profitable at current copper prices. In the longer term, though, the copper story remains intact, particularly with demand from electrification and renewable energy. But in the near term, copper is quite cyclical and demand is closely linked to global industrial production and, of course, economic growth. Now, this week in Under the Microscope, we're looking at EDU Holdings, a tertiary education provider operating across higher education and vocational training, with higher education now contributing roughly 80% to their total revenue.
Yeah, this is a pretty interesting company, Kien. I mean, the high percentage of revenue was contributed by the shift in mix, and that has been the key driver over FY25. Higher education courses run longer and also carry higher fees, so you get better visibility in terms of your revenue base. Although it does mean the business is more reliant on student intakes, particularly those from overseas.
Yeah, definitely. And that's where the growth has come from, Jace. Enrollments were up around 36%, with roughly 90% of that driven by international students.
Mm.
With a relative fixed cost base, that's translated into a meaningful lift in their earnings.
That's exactly right, Ken. And what we're seeing is that come through in terms of operational leverage. So returns have actually stepped up quite sharply. Return on equity has moved from around 20% in FY24 to a pretty extraordinary 85% at the end of FY25. And also we've seen a pretty meaningful expansion to net profit margins to around 18%.
Yeah, those are quite attractive figures there, Jace. But this raises the question, how much of this is sustainable?
Yeah, we did have a couple of questions on the back of this from a number of members this week, and I mean that's the key part that most investors are asking. And look, I think the way to answer this is some of it is structural. I mean, the shift towards higher education does help the company's investment thesis, but a large part of it is still tied to the strength in international student demand, and that's where things may become slightly less certain.
Yeah, definitely. I mean, it's worth noting also that growth has been strong, but it's off a relatively low base compared to larger institutions like Melbourne or Monash, universities.
Yeah, and that's something members need to be cognizant of. It's not a traditional moat type of a business. There are obviously barriers, Keen. I mean, the company does have teaching accreditations, they've got course approvals, and they also have recruitment networks, and but these are not insurmountable types of factors. So over time, competition can respond if the economics remain attractive, and this is it depends on how the company responds to competition, which will outline its fundamental sustainability into the future.
Yeah, definitely, Jace. I mean, investing in this business, it's the demand that's still anchored to those outcomes. For instance, students are paying for employment pathways and in some cases, migration outcomes. So that underlying demand driver remains quite important here.
Yeah, and also onto the income perspective, I mean the stock screens relatively well. So if members are looking for a dividend yield of around 7 to 8% grossed up, also payout ratio at pretty unstretched levels at around 30 to 40%, then this company may represent a potential income exposure. What's also positive as well, Kian, is that free cash flow covers the dividends relatively comfortably. So we're pretty comfortable with that as well. And from a leverage point of view, the balance sheet is also not geared with a net cash position of around $18 million.
Yeah, I notice in terms of outlook, there is one contributing analyst, which is forecasting growth into financial year 26, but that growth is expected to moderate in the following year as enrollment growth normalizes. But of course, only one analyst creates a bit more uncertainty in their outlook.
Yeah, that's right, Ken. And also just I want to touch upon what you just said in terms of enrollment growth. I mean, that's the key risk for this company, which is regulation. International student caps are being introduced in Australia, and this remains a bit of an overhang. And any tightening in terms of visa settings would definitely flow directly through enrollments. So the company also has the vocational education segment, and then this has been a bit softer and is lagging in terms of higher education, and that could continue to weigh on the group's growth profile if it doesn't recover.
Yeah, definitely those risks are worth watching. But for now, the company does meet our star growth and star income criteria, but the outlook is closely tied to policy settings and student flows, which we'll continue to monitor from here. And so the question of the week this week, especially with the evolving Middle Eastern crisis, how has this impacted the earnings outlook for equities for the year ahead?
Well, this is a pretty multifaceted question, Kien, and there are plenty of professionals that could answer this better than myself. But I think from my point of view, the main transmission mechanism is obviously into energy prices. If we have a look at the period earlier into the conflict, oil moved above $100 per barrel, and this increased costs across the global economy. Economists are now expecting inflation to move towards or above the 4% threshold as a result of this. But also at the same time, markets are pricing in a potential for further rate increases on the back of this. And we have seen the RBA move towards the 4.5% mark over the course of this year.
Yeah, and all this impacts economic growth and directly also feeds into corporate earnings. Higher input costs compresses margins, while higher interest rates increases financing costs and also weighs on consumer demand.
Yeah, oil is the lubricant of the global economy and flows into many facets of most businesses. And we are already seeing this reflected in some of the earnings expectations from analysts who have revised some of their growth forecasts lower, particularly in sectors such as those within discretionary, while more defensive sectors are holding up a little bit better in this environment.
Yeah, and you can see this with the chart on screen, which shows the trend in earnings revisions from year to year. Earnings revisions have moved lower in financial year 27, and earnings growth is now expected to be around 2 to 3% next year. And that's a stark contrast to the 10% growth rates expected for the market this financial year.
Yeah, but what members need to take away from this is it doesn't mean the market returns will be subdued. We've seen a lot of these Trump taco trades over the past couple of years, Ken, and when things rally, they rally pretty hard. So the important note to take is if you are a growth investor, focus on those companies that may have been oversold and continue to grow their earnings strong for the year ahead. And you can do this by referring to some of our watch lists and also some of our filters that's nested within Stock Doctor.
Yeah, that's right, Jason. From an income perspective as well, growth in earnings and cash flow is also important because not only does it improve your chance to generate capital gains, but it also ensures your dividend is sustainable. And those with strong financial health, pricing power, they are better positioned in this environment. But that brings us to the end of this week's episode of Taking Stock. If you have any friends or family who you believe should benefit from Stock Doctor, please feel free to share our referral link.
And just a thank you for everyone for joining us. We look forward to speaking to you again next week.
Yeah, until next time, have a happy, healthy, and prosperous week ahead.